Now, here we're going to look at how some key bonds are performing right now. Is it a good time for investors to jump in? We're going to bring in Konstantin Boehmer, head of fixed income at Mackenzie Investments. He's here in studio. All right, so we see the 30-year there in the U.S. Near 5%. And we were talking off air that this is not just a U.S. story. We've got the Japanese 10-year at a 12-year high, the UK gilt at the 10-year at a high not seen since 2008. So can you sum it up in terms of what's happening with bond yields right now?
Yeah, so bond yields are certainly on their back foot. I think it is driven mostly by the US. I think UK is maybe not too far behind in that move, but it is a US-led story where we've seen yields rise quite significantly over the past couple of months. But I think we're approaching levels, especially in the US, where we should take a pause and take a look at, do they look attractive here now, or is there still more room to go? Because the sentiment is fairly negative on bonds overall, and that typically often coincides with turning points in markets.
So I heard one of your, not a colleague, but a peer of yours say that at 5% on the 30-year in the U.S., that looks pretty attractive to me. So are we getting to levels where we will see investors say, you know what, I want that yield, and I think they're going to come down and the value will go up?
Yeah, I mean, I have not spoken to many who are overly excited, but the way that I look at it is there are different kinds of bonds, and one particular bond is very important for me, which are inflation-protected securities. So those are bonds where you get a yield and then you get the inflation compensation on top. So if I look at that yield, we're now at 2.55% for the 30-year bond. So that is the real yield that investors are getting. And on top of that, they get whatever happens to inflation. And that looks quite attractive. And I think that is probably getting some of the big investors back into the game, because that is, like, on historical standards, one of the most attractive yields that we've seen over the past couple of decades.
So are you referring to tips? Or
yes,
people
exactly.
should buy tips, perhaps?
You can look at tips and buy tips, but I think it is even more so a signal for overall fixed income, that this is reaching now levels that are starting to look attractive again. And for anyone who has a time window which is not just looking for the next couple of weeks, right? The next couple of weeks with Inauguration Day, anything is possible. But if you have a little bit of a longer time horizon, starting to look at fixed income again probably makes a good amount of sense.
Now, the differentials between Canadian bonds, primarily, you're talking about corporate, or the corporate bond spread between the U.S., or more so government? Government, okay. Yeah. And so the spread is very wide. We know the Bank of Canada has been cutting, the Fed less so. Is that the main reason, or what are the main reasons?
Yes, so that spread is exceptionally wide. So if I look at 5 years spread between US and Canada, 10-year, 30-year, we're talking anywhere between 135 basis points to 150 basis points, which is the highest it has been, I don't know how long, however long Bloomberg goes back. So that is, let's say, 35 years at least. So that is exceptionally wide. And there's, I think you're correct, the one piece of that is the two different central banks. We've seen 175 basis points of cuts here in Canada and 100 in the US. So there is some difference here. But I believe it is just that the economies are on different trajectories, right? Where we've seen the US humming along, growth looks reasonably strong, labor market is still good. And then on the other side, we look at Canada and we have our unemployment has risen quite a bit. We have the housing market, which is a little bit in a troubled spot. And then we have on top of that now also the threat of massive tariffs coming our way alongside the political situation that we have. So there's a lot of negativity currently around Canada, and that is just a drag on growth. And that is how we can look at those two countries moving in opposite directions. That spread of 150 is wide. So I would not necessarily think that that should go all that much wider. But at the front end, I have high expectation that Bank of Canada will cut a lot more in next few meetings.
Right. We've talked to some guests who say by the end of the year, the key rate may get down to, say, 2.25 or 2 even. And so does that make Canadian bonds just comparatively more attractive?
Probably yes. Yeah. So I would be in the same camp of believing that policy rate should go probably to 2%, if not below. That is currently not priced in the market. So that could lead to more and better performance in the fixed income market. I think that's probably reasonable. So Canadian fixed income is also still in an overweight position in our mandates. So we like Canadian fixed income, but it is a good amount of that differential between the US and Canada has been harvested. And looking at the US now as an attractive place to invest is probably also not a bad idea.
You mentioned Inauguration Day in the United States, January 20th. That's coming. I'll ask you the same question I asked Vince from Bloomberg, Vince Signorella. Are the bond vigilantes sort of rearing their heads now in that they really don't want to see U.S. debt and deficits go higher under Trump? Are they kind of flexing their muscles in a way?
Yeah, that is maybe also the reason you mentioned the UK earlier. The UK is the prime example of the bond vigilantes, of how they were able to get political change by not giving the check mark behind the budget proposals.
Under Liz Truss, right,
exactly.
Yeah, a couple of years ago.
So yes, I think there's a little bit of that aspect, but I think the U.S. market is a different ballgame. I don't think this is the same story as we've seen in the U.K. The U.S. has the privilege of being the reserve currency. There is, yes, debt levels look gigantically large, but at the end of the day, it's still U.S. treasuries, it's the U.S. dollar. So I don't think the bond market will really lead to a gigantic sell-off as we've seen in the U.K.
Okay, Konstantin, we'll wrap it up there. Thanks for the insight.